Let me try that again. Good morning, everyone. All right, we're awake. Welcome to Santa Clara. Welcome to the NAIC/Stanford Cyber Initiative Day on cyber insurance and its evolving role in helping to mitigate cyber risk. It's a mouthful, but a very important issue, and thank you all for being here. My name is Ben Losky. I was once a regulator in a state called New York. Very happy to be with you in Silicon Valley for this timely discussion. Looking around this room, it's clearly packed with profound expertise and experience from the insurance industry, from government, from law, from tech. And as I'm sure we'll discuss throughout the day, dialogue amongst all those groups, amongst tech, with government, with the industry, is going to be just essential in addressing what I think many of us consider to be one of the greatest threats we all face in the 21st century, and that's cyber risk. At the outset, I want to do a bunch of thank yous. First, thank you to Stanford and its Cyber Initiative for co-hosting today, and a big thank you to the NAIC for organizing this event. I want to thank in particular my friends Mike Considine, Ted Nickel, Andy Beal, Nikki Hall, and Eric Nordman, among many others at the NAIC, the many others who have helped put all this together for us today. I also want to thank Allison Burke at the Stanford Cyber Initiative, and to Jared Alasta, who works with me and is really essential to everything I do in my work now as well. And I would be remiss if I didn't just pause and just put an exclamation point on thanking Andy Beal and his team at the NAIC. I think when I was a superintendent or a commissioner back in the day, I was busy doing my own work and didn't fully appreciate how great Andy and his team are and how essential they are for the work all the different commissioners do. So if you'll join me, I just want to give them a round of applause to thank them. Let me also thank all of our panelists. You're going to see them all and hear from them all today, and our moderators, and a special thank you to those of you who've traveled from far away. It's great to see so many current insurance commissioners who I knew well in my former life, and staff from various insurance departments from around the nation in the audience. I obviously know all of you from my old job, and I hope, importantly, that all of you will continue to consider the Stanford Cyber Initiative a resource you can tap into on a go-forward basis. This should not be a one-time come over to Stanford, Santa Clara, and do a hearing, in my view. This can be something that can be an ongoing relationship, and Stanford, as you get to know it, you'll find is a very, very special place, and I think can offer be a great resource for the NAIC and all the commissioners. Let me also thank in this audience a special group, which is the entrepreneurs and startup companies that are in the audience, and encourage all of you, and you know who you are, to participate and weigh in throughout the panels today when there's Q&A at the very least. Because there's no question that innovation and advances coming from the tech sector, whether it's machine learning, artificial intelligence, big data solutions, blockchain technologies, or other advances, frankly, that I'm not smart enough to know about, that all those things will play a key role in the maturation of the cyber insurance market in the coming years. So with those thank yous out of the way, let me give you just a brief, very quick overview of today. We're going to hear, as I mentioned, from some of the leaders in the cyber risk and cyber insurance field. And in my view, this is an urgent discussion. Over the past years, we've seen signs of some real growth in the cyber insurance market, but that's coinciding with historic cyber attacks, including most recently the Equifax data breach, all of which promise to accelerate the growth of this market. Recent estimates predict global cyber insurance premiums will rise to between 8.5 and 10 billion by 2020 from about 3.4 billion in 2016. Now that's huge growth, but consider the following. In 2016, global annual losses from cyber attacks were estimated to be 400 billion. Just in the US in 2016, total losses resulting from cyber attacks was 100 billion. And when you consider the possibility, and it's not fun to think about it, but I think we must, when you consider the possibility of a truly catastrophic cyber event, the potential losses are staggering. One very smart insurance CEO was reported to say about cyber risk that it was, quote, the biggest, most systemic risk he had seen in his 42 years in the insurance industry. So the challenges facing the cyber insurance market are well known, and we'll cover many of those challenges today while also hearing from our presenters about possible solutions. Let me give a few introductory remarks from a process standpoint, and then we'll begin. We'll dive right in. We've organized the program into 3 segments with 3 big themes and a keynote in the middle. The first panel, which will begin in just a few moments, will focus on the current state of the cyber insurance market, including how it has evolved in recent years and trends in policies going forward. The second panel will address the range of cyber threat scenarios and the challenges of risk management for cyber insurance. We're going to have lunch at noon. Hopefully you'll enjoy that. And then at around 12:45, we'll hear from Richard Clark for the keynote address. I'll give Richard a proper introduction later, but let me just say that we're very lucky to have someone who has really been in the trenches in fighting the cyber war at the highest levels, advising presidents of both parties. We're very lucky to have him with us today. After the keynote, we'll have the third and final panel of the day that will be organized as a roundtable discussion with all of the previous panelists. And that final discussion will focus on gaps in the cyber insurance market and potential policy solutions, including ways that potentially government can work together with the insurance industry, all in light of the previous discussions we've had on the other panels. So just a few other points. We'll have a Q&A session during the final 10 to 15 minutes of each panel. You should all have programs in front of you that list the plan for the day with the times of the panels and bios for all the participants. I should say that all the panels have been designed, I think, to build on each other so that to the extent you can stay throughout the 3 panels, I think you'll find that most useful. We'll have breaks throughout the day between the panels 1 and 2 and a half-hour break between the keynote and panel 3. And with that said, let's get started with panel 1. I'm going to introduce the panel right now. It's titled, again, Understanding Current Insurance Coverage for Cyber Risk. As I just noted, the cyber insurance market is growing fast, but it's still, some would say, immature, and there's not a lot of clarity, some would say, about the types of coverage or where those coverages come from that are being offered, the pricing for the policies, or how different policies compare. So in this panel, we have gathered a group from the industry to provide an update on where we are today in the cyber insurance market, where we've come from, and where we're going next. To moderate panel 1, I'd like to introduce my friend, Commissioner Ted Nicol. And I should just pause and say this whole event got started with a call between me and Ted almost a year ago, and we talked through 3 main ideas, and those 3 main ideas led to the 3 panels that we have today. So I think it's great that Ted is moderating the first one. Since 2011, Commissioner Nicol has led the Wisconsin Office of the Commissioner of Insurance, where he serves as Wisconsin's chief insurance regulator. He also serves as president of the NAIC, where he chairs the executive committee and the government relations Leadership Council, among many other leadership positions. He's also a member of the Cybersecurity Working Group. Now, prior to being a regulator, Commissioner Nicol spent almost 18 years as Director of Governmental and Regulatory Affairs for Church Mutual Insurance Company in Merrill, Wisconsin. And he has also served on the boards of the Wisconsin Insurance Security Fund and the Oklahoma Property Casualty Insurance Guarantee Association. He earned his bachelor's degree in business administration with a concentration in finance from Valparaiso University. And he's also, I'll just tell you because I know him personally, and maybe this is the most important quality, he's a great dad. He and I have kids around the same age. We're often comparing, and I can tell you last night at our cocktail party, he was taking breaks to find out if his wife had gotten his daughter into bed. And so amidst all the work he's doing with the NAIC, he's still taking care of that as well, and I think that's great. So please welcome Commissioner Ted Nickel.
Thank you, Ben. You're very kind in that introduction, and I'm certainly excited to be here today. I did actually get a chance to talk to my wife last night, which was awesome, and the kids are doing great. I want to get started with our first panel this morning. We've got, what happened to Peter? Where's Peter? There he is. We've got three great panelists. Before we get started, and before I just do identify our panelists, I do want to also just breathe a word of thanks to all the regulators who traveled far and wide to get here and join us for this great discussion today, as well as several other important discussions while we were out here talking to the InsurTech and FinTech and those communities. But also obviously thank Stanford for co-hosting this event, and it really did indeed start with a phone call between Superintendent Losky and I late last year, and this again wouldn't be possible without the great support of Stanford as well as the great team at NAIC. So I just want to publicly thank all of them for their support, and thank the rest of you for being here today for what I think will be a great discussion. I'm hoping we have a good table setter this morning. We've got three great minds in the cyber insurance world to kind of discuss some of the very key issues around cyber insurance, and then we'll branch into the other panels as we move through the day, but I'm looking forward to that. I was going to start out talking about health insurance, but I figured we'd had enough of that for the year. Let me just quickly just go through our three panelists this morning. Peter Ulrich, to my immediate left, is the Senior Vice President, Risk Management Solutions. To his left is Laura Caragnes. I still didn't do it right. Corogenius. That's how we do it. Genius. She's cyber product, I can never do it, cyber product director, nationwide E&S specialty. And then to my farthest left, no political implications there, Carl Peterson, Senior Vice President, nationwide commercial E&O. He's also part of the Cyber Center of Excellence as a senior advisory specialist from Marsh. So I think we have a great panel that can really table set well today the key issues that we want to be discussing and thinking about moving forward. The rest of their bios are in your program, so feel free to look them up and verify their bona fides, but I can guarantee you that this is a very great panel, and we'll have a great discussion. So with that, as I sit down, I just want to maybe open up the panel with a quick question for Laura and Carl. We hear the term cybersecurity policy and cyber liability policy used interchangeably. Let's start out with an opening question. What's the difference? Is there a difference?
Well, there's a huge difference, but first of all, I do want to thank the NAIC, Nikki and her amazing team for the hospitality, as well as Stanford. And I don't generally say that as a Cal grad, but I am saying it today, so absolutely go Bears. Thankfully, we're not having this conversation in November during Big Game Week. It's interesting, though, when we're talking about cybersecurity and really the differences from a terminology standpoint. When I started in this field, actually when I had hair as an underwriter many, many years ago. And we first called them internet liability policies, and then we morphed into cyber liability policies. I still don't necessarily like cyber liability as the nomenclature, but we're probably stuck with that. For a long time, we wanted it to be network security privacy liability policies, because that's really what the main focus was these very large privacy breaches. Now I think cyber does work, only in the sense that we're going to be talking about non-physical business interruption today, which is a really, really key aspect of what we do. But when it comes to cybersecurity and cyber liability, is there this end-all be-all? We're always going to be catching up with the Joneses. I can literally buy hacking tools on the dark web and be able to you know, in essence, look at anybody's machines that are out there. So I think it's always going to be one of these things that we're always going to be catching up, but I think the industry is doing a phenomenal job. But certainly from a cybersecurity standpoint, cybersecurity encompasses quite a bit, and we'll talk about a lot of that today, because it is people, processes, and technologies. And quite frankly, a lot of the times it's the people element that causes these very, very large breaches, and we're never, ever, ever going to get around that. And so we can model as much as we want to, but at the end of the day, I've been a broker now for 17 years, and of the more than 100 cyber losses that I've had, I would say about 75% of those were caused by human error. And so that's not necessarily anything that we could actually underwrite. And so I always, always, always give credit to the carriers that are in the room that are providing support, because we are really in the eye of the storm, so to speak. This is the only line of insurance where the actuaries aren't comfortable yet. This is the only line of insurance where we are right in the middle of the perfect storm when it comes to trying to deal with these particular matters. And so I don't necessarily see that it's going to be that full fulcrum, but again, it might cross down the line.
You will hear these policies called anything and everything. I always tell people, look beyond the title, because the title doesn't say much. For a while, every carrier's form had the word net in it, and it doesn't matter what you call it. The policies are continually evolving. They're different from carrier to carrier, but we have finally sort of settled down into some basic coverages that most policies cover that are titled cyber or whatever. I always feel like I should get or my ex-employer should get just like a little royalty every time somebody does use the word cyber liability, because it is actually a trademark or trademark name of the original cyber policy, and it hung on from there, and it doesn't mean anything when you hear it, especially because coverage has evolved so that the liability portion is not the most critical portion when it comes to paying out claims at the end of the day. It's kind of stepped back and taken second place to everything else. So don't worry about the names, look at the coverages, and there's basic agreements that you need to see in these forms to know whether it's going to address the needs or not.
Yeah, and just a quick follow-up on that. So just so we're clear, we're never going to get through the questions that I prepared, because I always want to follow up on things. But you know, talk a little bit more about you know, some people think of cybersecurity as just data theft, and data breach and the loss of data. But there's also PD, there's also BI, and some people kind of confuse. Well, if I've got a cyber policy, I'm good for all three of those. Now, I've heard recently from folks at Lloyd's that they're very narrowly trying to work through some of those issues and make sure that the coverages are covering what very, very narrowly tailored to specific loss types. So I don't know if you want to just touch on 3 or 4 different definitions of what maybe some people think is cyber, and then other people think as maybe a PD or a BI claim that might be covered under another policy.
Well, historically, cyber policies have all responded pretty much strictly to a financial loss. There isn't BIPD coverage in the basic standard forms. That's evolving, and it's evolving in several ways as we move from more of a liability structure to first-party cost structure. And when you start looking at business interruption and data restoration and hardware and component restoration costs, then you are moving into PD, and you're moving into it when the breach actually is the cause of physical damage. And I think while we're tiptoeing into it and moving into it in certain lines, most cyber markets would say they're not ready to start covering BIPD on a grand scale on cyber forms. And that's one of the things we're struggling with. If you're going to try and effectively carve it out of all your other coverages, the cause of loss, the cyber breach, then you're going to have to figure out where you're going to pick up the BIPD that's a result of that cyber breach. And that's something I think the marketplace is really struggling with. What do you think?
I couldn't agree more. I think there's just still this general perception out there that the cyber policies will cover these end-all be-all of, oh, if it's not covered in my property policy, it's not covered in my GL or my crime policy, the cyber policy is going to pick it up. One of the slides that I have is the number one asset I think that's really not covered right now via cyber policy that everybody still talks about is really the corporate IP side. I happen to oversee intellectual property for Marsh as a product and service class. And when you're talking about trade secrets and you're talking about first-party trade secrets, so these cyber espionage, and you hear about loss of data and you hear about loss of corporate assets, that's not covered right now under a cyber policy. That has to change. You know, and that's something that we are certainly trying to change that paradigm within Marsh. And we actually have a new form that covers it as well. It's trying now to get the carriers in support of something like that. So there's different types of, again, assets. Historically, people were really only concentrated on the third-party elements. We understand a lot of that now. We understand what constitutes immediate versus future damages. There's a lot more clarity than there was even 7 years ago. You have to realize that really, cyber really only evolved because of SB 1386 here in the state of California. If we didn't have a state privacy law, which was the first, we would not be talking about cyber right now. So it's only because of the regulatory element. It's only because the state folks up in Sacramento were not hacked, not once, but twice, but 3 times. And they decided to do something for the greater citizens of the state of California. Now we are here talking about the subject matter. So it's interesting that brand and reputation, as well as corporate IP, are still not covered. And those are really the 2 main drivers, at least from a client basis. We have, I think the loss count from a Marsh standpoint is we have over 1,950 clients that purchased cyber here in the United States alone. So we have a pretty large market share when it comes to clients that are purchasing, and they still are coming to us and say, how come I can't get my branding and reputation covered? How come I can't get some of these intangible assets covered that I truly do want to see covered? And we're trying to shift that paradigm, and we're always trying to change the direction, but it's education. But you have to think about where these carriers have come, even in the last 5 or 6 years. They are constantly changing their policy forms, not on an annual basis, not on a 10-year basis. They're doing it every 6 months or so. And carriers are constantly coming out with new innovations, with the lack of understanding still. So again, I give a lot of credit. As a broker, I will always represent my clients, first and foremost, but I give a lot of credence to the insurance carriers that are supporting this line of insurance because, quite frankly, they are in the undiscoverable. They are in these unknowns that are out there that we still haven't quite figured out.
So great answer, and that's, again, really helps with the table setting. I think, you know, as a, let's say just someone from the general public, as a non-insurance geek like all of us are, insurance geeks, all we think about when we think about cyber is, oh my gosh, this just started with a hack of Target. This just started because a lot of these are bigger breaches and they're getting more notoriety and the press is covering them more. Obviously, from your all's experience, you've been in the trenches working on this for years and years and years. But it seems to me, and as you just mentioned, Carl, the rapidity of updating policies is changed, and it's increasing ever more quickly to try to identify or try to keep up with new causes of loss and new threats. It's really changed, and again, but relative to other insurances, it's fairly new, I guess, as cyber would be. But it's the underwriting cycle has changed a lot over the last decade. What, you know, as you think about it, both you and Laura, what do you think has changed? What lessons have we learned so far?
Well, one of the things that is interesting to me is the insurance industry made a couple of key decisions, I think, in the mid-1990s that kind of get us to where we are today. And the first was we decided for one of the first times that we were going to stop being a reactive marketplace, seeing exposure, monitoring it, measuring it, understanding it, and then figuring out how to insure it. And instead, we decided we would become proactive. We were insuring technology-related risks through professional liability lines, and we were seeing these exposures evolving, and we were hearing whispers of exposures that were out there, and we made the decision that we're going to try and be proactive here. We're going to start creating policy language and policy coverages without really knowing what the exposure is, which in hindsight sounds really stupid to me, but you know, it's what we did at the time. And where the infancy of cyber coverage came from was generally errors and omissions policies, because the basic coverage grants of unauthorized access and insertion of a virus started showing up on E&O policies, usually as exclusions in the late 80s, early 90s. But we've been writing this exposure since the late 80s and early 90s. We wrote CompuShare and Prodigy and Microsoft in its early days. And so as it's evolved, we're continually playing catch up. We're trying to figure out where technology is going, so we'll be prepared to respond to it. And then we're also perpetually having to stand back and go, oh no, we guessed wrong there, we need to go in this direction. And one of the things that I think is the most interesting is where cyber coverage came from. It came from professional liability. It would look completely different if it had started in the property market. Maybe as to where cyber coverage sits today, that's maybe where it belonged more, but it started in the professional liability marketplace. Professional liability underwriting is very different from property or general liability underwriting. We have a very set focus in how we underwrite. So what you see in coverage in the form today is because of where it got started and because we started out trying to anticipate rather than react to exposures. So it's continually changing because we're finding out we're wrong in our guesses, or sometimes we're really right. I don't know who first started the computer extortion coverage that came about. Oh, you started seeing it on policies about 10 years ago? Mm-hmm. And for years, underwriters would say, whenever somebody asked me what's covered under computer extortion, we'd go, I don't know. It's hard. The one example I knew, I would exclude. So it was a coverage that was out there. We offered it. We didn't know whether to charge 1% or 100% of the premium because we had no idea what it was. And then all of a sudden, ransomware attacks started. And we had figured that out in some way, whether it was dumb luck or we really did know what we were doing. And there was coverage in place to respond to ransomware claims as soon as they started occurring. Now, most people that were getting hit with them didn't have the insurance. But if you were lucky enough to have the insurance, it would have computer extortion, and you could look for help on your ransomware claims. So sometimes we guess right, sometimes we guess wrong, but it is very much a learning curve, and we are making it up as we go along.
I think when I was an underwriter back in the day, we were concerned about Y2K, and if people think about what Y2K was out there, and that was the big concern. And certainly still, when those days where I was more concerned about the $2,500 to $3,000 laptop than the data that was contained within that laptop. And that vernacular has changed. And I think that we're starting to see this shift. We saw that shift in terms of really understanding what privacy constitutes and really what constitutes privacy in the digital age. And again, why I wasn't necessarily happy with the cyber perspective was there's this misnomer of cyber's only covering intangible assets. No, it can still literally be a box of records. And the number of very, very large losses that we've had from a physical loss of data, physical loss of records. And so it's just not that electronic mechanism. But what Laura said, absolutely, we are constantly trying to change, and that's why I give a lot of credence to the carriers that are out there. Quite frankly, I think a lot of these changes are because of the regulatory side, and certainly state attorney generals have a large importance on that factor of policy forms evolving and changing, just like what we're going to see next year with GDPR in the UK, or in the EU. That's going to change promulgations with respects to privacy and regulatory events, and how we're going to change that, because the delineation from a GDPR standpoint versus the patchwork of 48 distinct US laws versus anybody else's laws. And so it's trying to catch up. Still, though, to this day, we don't have nomenclature down. So if you look at a cyber policy these days, the carriers will still call the tenets of the policy something different. So the clauses, The basic forms themselves, yes, they are covering, but they're all unique into themselves, and so it's very, very difficult for the generalist out there. So I'm very fortunate that I'm part of a national team. There's, I think, 32, 33 of us now that just specialize in cyber and E&O, as well as media. That's our main job, 100% of our time, and we're still trying to keep up with everything. We're still helping carriers write their forms. We just came out with our own form this year, which is probably the broadest form in the cyber community these days. But it's interesting to really trying to force that. And you see these other long-standing lines of insurance, and you don't necessarily see this fast pace. And that's what I absolutely love about cyber. But again, I've said this before, I'll say it again. I give credence and a lot of credit to the insurers that are actually putting their dollars down on behalf of companies.
So I want to get one more kind of, again, kind of a table-setting question and kind of a little bit of an angle from the consumer side. I think one of the things we forget about when we talk about cyber coverage, cyber insurance is, that a lot of what we're talking about is larger organizations with risk management specialists, with CIOs, CFO, just very large, sophisticated entities who have their board telling them, make sure you figure this stuff out and make sure it's covered. One of the things I think we miss is, and how do we do this better? We're missing the middle market. We're missing the small businesses. We're not making sure that they're getting the proper coverage. I think from what I've understand or what I've heard is that a lot of small businesses have been hacked or they've been hit with ransomware, but they either can't afford to fix the problem or they're too embarrassed to tell anybody about the problem, and so they may not be getting the correct advice, or they're not getting enough advice, or they don't know what they don't know. And how can we better address the cyber needs of not just larger corporations, but small and medium businesses who face the same threats, but may not have the sophistication or think they have the financial wherewithal to pay for cyber coverage. And I think this is where insurers do a good job at providing loss control, loss prevention, risk management services. But I think a lot of small businesses just don't realize it or don't recognize it.
I think that's true, and the ransomware attacks has probably done more to drive small to mid-sized businesses to the marketplace because they can relate to that. They don't relate to what happened at Sony. They don't relate to what happened at Nationwide. They don't relate what happened to Equifax. They relate to knowing that the dry cleaner chain they compete with in their town had a ransomware demand made against them that they heard about. And so that's the type of exposure that's finally drawing small to mid-sized businesses to the marketplace. A lot of them don't want to admit they've had a breach, but and never do. They just act like it didn't happen and move on. They don't notify, they don't report, they don't do anything. But a lot of them, what is driving them to start looking at the insurance isn't the insurance itself. It's that if they do have a breach and they know they need to do something, but they don't know what to do, they want to know they can pick up a phone and call somebody and talk to an expert who will say, okay, we'll get an investigator in there. We'll help you with your notification letters. We'll see what states are involved. We'll carry that through. We'll manage all of those steps of the process once the breach occurs. They're buying that more than the liability insurance, or more than any of the coverages, is that peace of mind, because they don't have a chief technology officer, they don't have a chief security officer. Some of the smaller ones have a brother-in-law, and that's about the extent of their network security expertise, is they know a guy that knows about computers, and that's still true today. So it is hard to drive them in. The premiums scare them off, even though I believe they're dramatically underpriced and low. But they are starting to buy into and believe that a single breach can put them out of business if they're not very, very careful. And I think they're starting to look at that. And a lot of it is, interestingly, not teaching those insureds. It's teaching insurance agents and brokers and the non-Marshes and Aons and Willises of the world how to sell this coverage to their insureds, because they don't know anything about it. They're generalist, they're scared. Some of them are older, they're not really well versed in the technology, and they're afraid to even bring it up with their insureds. They don't even want to talk about it. And so training them in how to present it and what they need to know, and making them feel comfortable to realize they don't need to have a degree in computer engineering from Stanford in order to discuss the coverage. And that's a lot of what I do, and it's a big job. But if you can get the insurance agents educated on the subject, then they can start talking to their insureds. New businesses, new startups, especially tech-oriented ones, they're getting coverage online. They know what they're doing, they understand it. But a lot of the traditional businesses in this country are more and more dependent on technology and know less and less about it as it evolves. And so someone like an insurance agent or someone needs to be the person that points them in the direction towards insurance coverage.
Great, thanks, Laura. Peter, Carl, any follow-up on that? Or did Laura hit
I would
it out
say
of the park?
it certainly is getting better out there from an SME standpoint, or sorry, small to medium-sized enterprises. I think that there's been some introductions of some policy forms in the last several years that have really helped them out. The most notable in my impression is an entity called Beasley. Beasley has a policy form called the Beasley Breach Response Policy Form that came out, I want to say, 6 years ago, that completely changed the dynamics. It's a HMO versus PPO plan in the sense that you have to utilize specific vendors within the Beasley program, but you know what? It's a very, very solid program. They have everything that a small to medium-sized enterprise needs that doesn't necessarily have that backroom support. So they don't have a full-time risk manager. They don't have the pre-agreed contracts already in place with their vendors that are supplying them, either from a forensic standpoint, from a notification standpoint, that proverbial privacy breach coach that's embedded, which is very, very, very important. And so I think they've changed they've changed the shift, and a lot of other carriers are following on that. So I think it's getting better out there. I think the pricing is getting better. I think that there's more and more people. From what we are hearing on the E&S markets, they're doing quite well. So I would say the market shares are increasing every year for small to medium-sized enterprises.
Great, thank you. So that's a good table set on kind of some of the issues with coverages and some of the concerns that we still have in the market. I want to just switch a little bit and draw Peter into the conversation and talk a little bit about what are some of the challenges in modeling cyber risk, and how can research and experimentation in this area be facilitated?
Sure, no question that cyber is a challenge to model, but something I hear a lot is, how can you model it when there's no data? And I would say there's actually a surprising amount of data out there. I mean, we've built a database of close to, I think, 30,000 cyber incidents. So it's certainly helpful that companies are required to disclose these, because that puts the information out there. But looking at all these incidences, you can start understanding trends of what types of attacks are occurring. Is it data breach, or ransomware, or financial theft, DDoS? So you can see what types of attacks are happening, what types of companies are being attacked, what sectors. Is it financial institutions, or healthcare, or education, retail? And what size companies are being attacked. So you can start to get a profile of what is going on, which is very helpful. The challenge is, what we're focused on is really more the aggregation risk, the big catastrophe events. And those haven't happened, so there is no data. So that is what makes modeling cyber challenging. There's no history to look at. And that's why we need to involve cyber experts, and I'm talking about people who are penetration testers. You know, that is their living to try to, they're hired by companies to try to hack in, to see how easy or hard it is. And it's people like that we work with to say, how big could something be? How broad could it be? Could these things really happen? And it's very similar to the way terrorism models have been built, because there are some people who very much understand terrorism capabilities, even though they haven't happened. But that's what we need to rely on to fill out the distribution of events. We have a lot of data on the small events. We don't have data on the big events. So we're looking at other sources to say what could happen that you need to be concerned about.
Would it be helpful? I mean, we just sort of mentioned that a lot of small businesses may or may not have even reported things for a variety of reasons. If there was better reporting and a better database of information, that would probably be helpful, at least sort of developing the sort of the themes and the threats. But you're right, in terms of modeling a very large cyber attack, fortunately we haven't seen one of those, so I suspect those would be difficult to model. I think this is one of the things that Stanford is looking at and thinking about. How would a larger cybersecurity event be potentially systemic in its losses and the damages that could occur. Are there any suggestions you have for ways to get more data or to develop more data? Is there a way to crowdsource it? Is there a way to find some sort of I hate to use the overused term sandbox, but is there a way to have people put data into other sources that could be helpful for the modeling efforts?
Well, it's fabulously valuable to get the data that's there today. I mean, we sometimes have questions about other countries. We think, is there no risk there? Or is it that they don't have to report any attacks, so they don't? You know, nobody wants to raise their hand and say, hey, guess what happened to us? So it is extremely beneficial that certain types of attacks are reported, and it helps the industry if everybody knows. You know, you don't have to show the confidential pieces of that, but it is definitely a benefit to the whole industry if there is data shared.
Sure. Carl, do you want to jump in?
I think it's interesting because I just put up a slide of notable first-party losses, and these really didn't even start occurring for several years ago. You know, the first notable loss was Stuxnet. And it's interesting that Stuxnet's, you know, still is talked about out there in terms of being such a historic event, which it certainly was. And we're all familiar, certainly, with the output of Stuxnet. But what's interesting is some of the variations thereof. And what we are starting to see, and what really caused a lot of consternation from the insurance industry perspective, which is probably our first, we have to really be considering this, is the NotPetya attacks that hopefully you all are familiar with as well, that started off earlier this year in the Ukraine, that could have been, and most likely were sponsored by the Russians. There's a lot of really, really good information about Petya out there, and certainly NotPetya. There's a distinction between the two of them because of the malware variants. But even on the Dooku side and some of the others, I mean, if the shadow brokers are out there basically selling NSA tools that have been hacked, that's pretty scary. What's the insurance community going to respond when the crown jewels of the NSA have been hacked by a third-party government? There's little that we can do to stop some of these losses, and notable sizes of some of these losses, hundreds and hundreds of millions of dollars in terms of these very well-known notable organizations. Was it a patching issue? Was it not a patching issue? You know, you can go back and go through a lot of that, and certainly people are going through, trying from a forensic standpoint to figure out how exactly this started and emanated. But when you do have dedicated nation-state attacks that are affecting general commerce, that is a concern from the industry standpoint. Do we understand really what constitutes cyber terrorism these days? Have we thought about the kinetic versus the intangible side when it comes to cyber warfare? I mean, my background from a college standpoint was in political science and escalation dominance theories when it comes to nuclear warfare and things on that side. I think there's a lot of parallels right now that we see in terms of what we're trying to address from a cyber standpoint. Because right now, we're trying to find out what the end game is on how do you stop a global cyber attack. You know, it's like following the Powell Doctrine when it comes to the actual tangible kinetic side. Do we have an exit strategy when it comes to cyber warfare, cybersecurity? We don't know that yet. How is it going to affect the global commerce? We don't know. And that's going to be the big, from a modeling side, that's going to upset the industry.
Okay, now I'm scared. Maybe just to follow up a little bit on Carl's question, and maybe a follow-up question for Laura and Carl. With industries becoming more digitally connected, I mean, it used to be you'd buy a computer which sort of helped you balance your books, and you had a little software program that took care of that for you. Now everybody's depending on each other for different services, and folks are digitally connected, and those relationships are changing dramatically. And you did touch on the fact that cyber policies are changing very rapidly as well, but are they changing to focus on those kinds of risks that are starting to develop as more companies and more businesses are becoming interconnected?
Well, when we were first looking at cyber coverages and trying to come up with definition of a risk that would qualify for one, we came up with risks that could not exist in the absence of the internet. And in the late 90s, there were companies that could have existed, almost every company could have existed without the internet, but there were increasingly more and more that was their platform, that was their channel. Today, the opposite is true, and there are probably less than 5% of the businesses in this country that if tomorrow we said, no more networks, no more internet, go back to your old business models, could survive. It's changed in that going from technology as a tool we use to conduct our business to technology is what allows our business to exist. And that means that it's getting increasingly difficult to segregate the exposure from that into a specific line of coverage or a specific policy when the technology has wormed its way throughout the country or out the company and affects all sorts of types of claims. And that's why you see on cyber coverage, we tend to periodically just add something to it. We add first-party investigation cost, then we add notification and credit monitoring, and then we add extortion, and then we add business interruption. We're adding those on versus saying, if it's a business interruption claim tied to a network security breach, it still goes on your business interruption policy. We're adding it into the cyber policy. So you could be, if you're watching how businesses are evolving through the use of technology and becoming more and more dependent on it, and it's more and more integrated to how they conduct their business and open their doors in the morning, does that mean eventually everything's going to be covered under a cyber policy? Those are the discussions that I think have to start happening. And when you talk about the modeling issue, we say, here's how much was spent on this breach. But what's really important when you're looking at it from a pricing perspective is, can you break that down to how much was spent on the investigation, how much was spent on notification, how much was spent on liability claims, what were the legal fees, how much was spent on data restoration? Because we have to look at all of those components when we're trying to do pricing. And that is, to me, the difficulty is eventually, does everybody have this one big mega insurance policy that's a cyber policy and that covers everything? And so, it's interesting to watch the evolution and to see how it evolves, but we are kind of building this big behemoth monster in the room with cyber coverages, and it will be interesting to see how much longer it stays separate and contained.
Peter?
Yeah, I think cyber coverage is going to continue to get better and better defined of what's covered and what's not, but something Carl mentioned was state-sponsored attacks, which is one of the things that we should fear the most, because if you're given essentially unlimited resources and a safe haven to plan things, you can do some pretty horrific things. And the challenge there is, if I was an insurer, I'd say, well, I'm going to exclude state-sponsored attacks. It's essentially an act of war. The problem is, North Korea is not going to raise their hand and said, I did Sony, I did Swift. So there's never going to be any attribution, so I don't know how you'll be able to exclude something like that. But that is an enormous problem and something that I would imagine keeps you awake at night. Yeah,
you have to say a breach is a breach, because so many of the times you don't know what caused it, where it started. More and more often I think we do, or we always have a good idea, but proving it to the degree that you could exclude it from a policy, would be really tough to do on a lot of breaches. So yeah, you just have to kind of say, we're a big tent, we take them all in.
Sure. So all perils, and all perils cyber. So just so everybody knows, Carl is like he's over prepared. So he's had a lot of different slides to show us. I don't know if you wanted to just follow up on that one at all with some of the
Well, sure.
the slides that you got up.
It's interesting because, again, we didn't necessarily have these conversations even 3 years ago. Now we are having these conversations on a daily basis, and I don't want to sound arrogant from a Marsh standpoint, but we have some really nice processes that are in place to identify a lot of these things, and we're actually working a lot of times with the carriers to make sure that we can dovetail these coverages specifically together. I would say the first notable instance, though, of really a carriers and/or an industry really trying to creep in is really from the non-physical business interruption side. There's one notable market, FM Global, that offers phenomenal coverages when it's associated with a non-physical event. So here's your typical triggers that are associated from a PD standpoint. They're actually covering non-physical damage, even if it doesn't necessarily emanate from a physical event. That's the first time we've ever seen that as part of a property form. Non-physical business interruption. Yes, the waiting period is 48 hours. You talk to people in IT, if they're down for 5 or 6 hours, they're toast. So still, we're not necessarily there yet. A 48-hour waiting period is a rather long waiting period, but it is interesting to, again, demarcate some of these things, and I think that we're trying to get better. We, within Marsh, just recently introduced a new form called CyberCat 2.0 that actually embeds property, GL coverages, crime coverages, all the needed coverages into a cyber form, and we can build a lot of those elements. And so we have bodily injury property damage associated now. But that's for clients that are taking some pretty sizable retentions north of $5 million. Is it still readily available in the SME space? No. Do we need to get there? Absolutely one day. But I think what you're starting to see is an understanding. Yes, there are some interesting decisions that have been made out there. The first that comes to mind is the KSR decision in Ohio, Kentucky area. But again, there's some interesting decisions from a court perspective of, we think that we have more clarity now in terms of what insurance policy should respond. But as a broker, I'm always going to tell my client, you're going to report no matter what. You're going to report under the various lines of insurance. It's not our job to decline the risk. It's the carriers to say it's not necessarily covered here. And it's our job then to push back if we think that there's some coverage. So I think it's getting better, but over a period of time. In talking about modeling as well, I just turned 50, but I literally feel like a kid in the candy store half the time because we have access to 5 or 6 different models that I can work with. So I can do a Monte Carlo analysis right now to figure out what are the optimal limits, what do I think the loss costs are, broken down by the various first and third party costs. And I have those finite details that I can share with clients. And so I think from a brokerage perspective, I think from an insurance perspective, certainly the services, the ancillary services that are available out there, there's a lot more clarity now than what we had even 3 years ago, which is really cool.
So as Laura said, there's coverages kind of getting added and added and added. Are you seeing some trends in what buyers are looking for?
Yes.
Are they wanting to just keep lumping on more coverages, or are they being more specific and we need cyber coverage to cover this particular threat?
The number one request that we are getting right now is for trade secret coverage, period. And we can't find the capacity out there. So we can only find about 200 to 300 million right now for any one given trade secret loss, which is not necessarily where we want to be. I think you're also starting to see clients really ask about non-physical business interruption and the various components of non-physical business interruption. So let's talk about supply chain issues in terms of dependent business interruption as well. And modeling in terms of accumulation of certain data. I know from a physical standpoint, the FedEx facility in Memphis is the most reinsured facility in the world, along with TMSC in one period of time. Well, what about from an intangible perspective? So there's a lot of things that are out there that we have to still aggregate from a data perspective from an insurance side, but I think we're getting a lot better. But from a coverage side, it really is that non-physical BI piece that clients are really asking. And they really are saying, well, I don't necessarily sell a product, but I am dependent upon somebody else, or what happens if there's a systems failure loss? So it's a cascading loss of all my dependent businesses. I've been the broker for several airlines that have had outages. And those are really, really fun to deal with, I have to say, because again, you're trying to figure out these backroom systems that are actually now in charge of your overall front-facing systems. What do? It's the infrastructure risk that's really, really important right now.
Laura?
And I think that to a degree depends on the size of the risk and the type of business they're in. I mean, if you're healthcare related, you want to know that the policy is going to respond to notification cost. You want to know that it's going to respond to HIPAA fines and penalties. If you're most small to mid-sized businesses that do quite a bit of credit card transactions, when you start looking for coverage, you want to know you're going to have coverage for PCI fines. And so it depends on where they're coming from, what's most important to them. Most of them don't think too much about the liability. What's driving it is they want to know that they're going to have money to investigate and figure out what went wrong. They want to know that there's going to be money there to restore the data that was damaged. They want to know that, yes, if they're going to be down and out of business for a short period of time, there's business interruption coverage there. So from their perspective, it's much more geared towards most of the existing coverages, and which one is most important to them depends on the size and the line of business that they're in.
It's interesting though, you just brought up PCI. I don't know why I'm thinking about this right now, but there's a lot of times in the general press too that, oh, cyber policies don't cover things. And there was a pretty famous incident a couple of years ago with P.F. Chang's, and they had a large data breach and they had a Chubb policy. And the press said, oh, well, this policy didn't cover any PCI fines and penalties. It's because the broker didn't ask the market to add it. And so again, depends upon what the broker's responsibility is to make sure that the client has the broadest coverage and understanding of what to ask for and what to delete from a policy form perspective. So just like any other line of insurance, you have to have a specialty associated with this, and you have to know what you're doing. You can't be a generalist a lot of the times, because these perceptions of what is covered and not covered, that ultimately is the job of the broker. The underwriter's not going to say, I'm going to give you everything, you're not asking for it. No, you have to ask for it, otherwise they're not going to give it to you.
Great, thank you. The fact that we're, again, still in a developing market, and we're still, and it's an ever-changing market, and there's not a huge amount of loss data. How do underwriters model loss costs to price these policies? And do they sort of do it for each coverage, or they do it at the policy level? Peter, you want to start?
Sure. I may have a different insight than Carl based on what he said before, but I have spoken to many underwriters, and I haven't come across any that are modeling a loss cost the way you might model a property cat loss, where you look at all the potential events that could happen and come up with a technical rate, or say an auto or life policy where you've got actuarial determined rates. I haven't seen that. I think the way most underwriters I've talked to are underwriting is being comfortable with the coverages they're providing and not providing, keeping limits manageable. You know, most policies I see are between $1 and $15 million, possibly deductibles, and then charging a rate that they think is, you know, what the market can bear. So they're comfortable with that standalone risk, but then this kind of the second step to the process is looking at deterministic scenarios across the whole portfolio. Okay, I'm comfortable with this risk, and this risk, but are there events that could impact all of these? So running scenarios on top of this to understand what's the risk to my portfolio.
It's interesting. We one of the model tools that I briefly mentioned earlier is think of it as a MFL-PML when it comes to your standard risk itself, and we can break those costs down. For the first time, we're actually asking our actuaries to go back and say, we need 100% of the data being lost. Usually what we do is we align it with confidence ratios, and so 95, 98, 99, it depends upon the size of the loss. We've really never had 100% of records exposed before until Experian and a couple of others that are out there. And so we're actually asking, clients are asking us now, oh, I have 120 million, 130 million records. Can you model that at 100% being lost? I never, ever would have anticipated that this time 2 years ago, because you always think, okay, there's enough DMZ zones. We have enough controls that are in place from a firewall standpoint to segregate our network. We don't have to worry about that. There's the redundancies that are in place, all the, from a technical, from an infrastructure side. But to literally now contemplate that I can lose every single one of my records, that's pretty scary. And again, the clients that we work with, I work with states. And it's interesting too that every state has access to every single one of your information out there. So I could be sitting in California but still have access to records of somebody in Arkansas, which is pretty scary out there if you know your way in the system itself. What's also scary is something like the news this morning, if it's true, and which I think it is true, about there's a outfit based in Moscow called Kaspersky. People know about them from an AV side. Well, the Israelis, turns out that they hacked into the servers in Moscow to figure out, you know what? This AV systems itself that were utilized by the DoD, various other entities here in the United States, was actually looking at every single bit of our data. Was the Russian government involved? Were the Russians not involved on that side? It's just so scary out there where you think these quote-unquote trusted systems. And here's my AV system, antivirus system, which is the most important system, on one of the more important systems that I own. And now all of a sudden that information is being transmitted to a server in Moscow so the Russian government can look at it. Pretty scary. And I'm not saying that the Russians are the only ones that are doing it. We have to look amongst ourselves and in the mirror as well. Every nation state is doing this. Every nation state is it.
So again, I'm scared again. As we try to chase the ever-changing market, as just the example you described, how things are changing, how good is the industry at being there to help support their clients in mitigating risk? How difficult is it for industry, as we see lots of people retiring, finding the talent necessary to bring in to be a part of that risk mitigation system? I mean, are they all going to DoD and all of the Stanford graduates are going to government entities trying to work on that, or are companies able to find the right people to provide those services to both the insurance companies themselves to protect their own data, but also to be there as risk managers and to be out there trying to help their clients identify those risks?
I think that the insurance industry is attracting a lot of people that have that experience and that background. What's difficult and takes time is you need, having that type of background, a technical background, is very, very helpful, but that doesn't necessarily mean you're a good underwriter. And trying to merge the two skill sets, which in many ways are different, is the challenge when we're bringing people along and training and teaching them, because technology, understanding the details of the systems and the antivirus software and how technology works is important. But what is also as important is still remembering how to underwrite a risk from looking at management, data management, employee management, all of those different factors. And where we're able to help in the mitigation process, I think brokers are in a different perspective than insurance companies are, because we're usually pretty far removed from the actual insured. So most of what we can do is give advice up front as far as, here's the things that are important to us. We want to know what types of steps you have in place to mitigate a potential breach. Because we operate on the process that no matter how good you are, it doesn't seem to matter. You're still going to get breached at some point. So what probably is more important is not so much the steps you take to avoid the breach, or as important is the steps you take to mitigate the size of that breach at the back end. So we put a lot of focus on those, and most of those are pretty basic management tools. A crisis management plan, a data retention plan, those aren't incumbent on the technology and the software, they're incumbent on good common sense management processes. So when you're bringing new people into the business that have a technical expertise, you also need to make sure they have a sound expertise when it comes to just looking at a business and say, does the way they manage their risk overall make sense? And does that transfer over to how they manage their technology systems and their cyber exposure and their breach exposure?
Sure. Thank you. Peter?
Well, I think mitigation is an interesting point here because I mitigate my auto risk by buying an auto policy. If my car's stolen, I get it replaced, I'm good. But Equifax is never going to be good. I mean, no matter what kind of coverage they had, they will always, always be that company that lost 145 million people's records, which is half the people in this room. Unless all the other credit score providers get hacked to the same basis, they're never going to be made whole. And it's not something the insurance company can do, but that is the nature of the cyber peril. It is a huge challenge.
And it's scary when people say, I mitigate my auto exposure by having auto liability insurance. You know, from a cyber insurance, we want to be a backstop. We don't want to be the primary answer you have to I've been breached. And that is a distinction in that, you know, we're insurance, we're risk averse by and large, and we want to be there when things are really bad, but we also want to know that you've taken steps to minimize how bad they're going to be, not just, okay, we're going to call our insurance company and it's a total loss. We want to know that you've got mitigation processes in place, that you have thought about this, and you know what's going to happen, and you're taking steps. I mean, to me, the biggest one right now, from my perspective, is a data retention policy. Because if you're keeping records on people you don't have to keep records on, but you're breached, we still have to notify all those people. You know, if you're keeping trade secrets or intellectual property material that you have no business keeping, it's no longer valid, or it's really not your property. It's been so easy to gather so much data, and we just have become addicted to it. Oh, I can have this piece of information on my computer. But then when you're breached, you've got to do something about the fact that that data is lost, whether it was of any value to you or not. So to me, data retention is probably one of the most critical mitigation factors that go to manage the size of a claim, manage the potential ultimate cost of a breach.
So I was on a panel earlier this year, and somebody asked that question, you know, in my Wisconsin vernacular. If I just get the cyber insurance, is that good? Does that make me good? Does that mitigate my risk? Like, no. You know, there's a few other things you might want to think about doing. But there, you know, there may be that perception out there from folks. It's certainly frightening. We've got just a few minutes, and I want to get some questions from the audience. But I just want to ask one more scary question before we take some questions from the audience, maybe for Peter and maybe all three of you that are seeing more information and having access to more and more of the scary stuff, and they're seeing the evolution of some of the cyber threats out there. Is it your sense that we're headed for a systemic loss? I mean, something that's really going to cripple a part of the economy.
I would say cyber absolutely has the potential for a systemic loss. And I apologize earlier when I said we haven't really seen the big attack. I mean, obviously, Yahoo and Equifax are just unimaginable. But when I say large, I'm thinking a systemic loss. So an example being if a hacker finds a vulnerability in a software that is widely used, something like an Oracle, and not to pick on Oracle, but something where they have amazing penetration in all the big companies across the world. Instead of attacking one of those, you get the resources to attack 30 of the top Fortune 100 companies at once. And that's the type of thing that the insurance industry needs to better understand. Not how do you price one risk, but what is the potential for these systemic risks that go broad. And I think most people are now aware that that's a very reasonable likelihood. I mean, and I think some of the trends out there, everybody's spending money on cybersecurity, which is great, but it's definitely reducing the small attacks. And hackers, there's more professional hackers who are much more serious. There's the state-sponsored risk. So we think the big systemic event is still going to happen, and that's what could cause the insurance industry the challenges, is when you lose not one policy but across 20, 30,
Right.
40 policies.
Right. Is that about what you're thinking, Carl?
Well, I would say, yeah, absolutely. That's a concern, because accumulation, and you guys are doing a great job in terms of accumulation of values in certain industries, and the science guys are doing really, really well in terms of identifying some things that are on the, that proverbial below the iceberg, so to speak, in terms of data and perceptions that are out there. I think that things are getting a lot better, but I am still concerned about, absolutely, if you have notable mainline clients. I had a very large technology client that had a large number of records that were released. They had the full encryption in place, but they also left the encryption keys in an unencrypted format in the same server. Generally not something that you would do. So these systemic losses that we may or may not necessarily have, I think, are still human related, but it all goes down to, again, the vulnerabilities in the systems themselves. People are familiar with the term zero-day. Zero-day viruses, the bugs that are out there that you necessarily haven't patched yet, you haven't followed that solution. If you have people like the NSA, the CIA, Mossad, everybody that's doing it out there, these are going to cause very large systemic losses against industry that the insurance industry is going to have to deal with, unless there's a governmental backstop. My own personal perspective is our infrastructure is probably the most secure out there from the clients that I've dealt with around the United States. I feel very comfortable from an information sharing perspective of what the folks in the utility side in that particular space are doing. But then there's others that are out there that scare the bejesus out of me. So you never know. You just don't know. And again, getting back to what we saw earlier about the NotPetya, or some of those types of losses, I think that that's just that's the tip of the iceberg, so to speak, in terms of what we may or may not see out there.
Again, scared again. All right. Thank you, Carl. Nikki has a microphone. Do we have questions? And Brian's got a microphone. Have any questions from the audience? Any startup company out there that's excited about writing cyber? Ben.
Sorry, I couldn't resist. Carl, you mentioned two areas where you thought maybe there was not enough capacity out there. One was for trade secret loss, and I think the other you said was non-physical business interruption loss. And so my question is really to Peter about those two areas, if you know. Are there problems modeling both of those types of losses? And if yes, why and what can we do about it? And if no, I guess the question reverts back to Carl, why isn't there enough limit out there to the extent you can hypothesize about that?
Okay, and our two types of loss again were?
Trade secret loss and non-physical business interruption loss. And if you want more details on what those are, Carl's the expert.
So I will admit, I'm not familiar with non-physical business interruption loss, so you want to give?
Sure. I think from a non-physical BI standpoint, by non-physical, its nature is just taking the physical risks in the intangible world. And that's really the supplier side, and so what we don't have right now. When I say that there's not enough capacity, we can build a tower of 700 million that includes non-physical business interruption. But when it comes to some of the subsections of non-physical BI, that's the problem, and those are the causes that you really have some concern about from a modeling standpoint and or accumulation. Because you have interdependent businesses, you have supply chain issues, there's a lot of different functions you have to think about of exactly who am I working through. Even in the PD world, physical world, think about what happened in the floods in Thailand several years ago from a disruption standpoint. You have these monolithic companies that are out there, such as the Amazon Web Services of the world and some of these others that control so much of daily businesses. Do we really know about that? And do we really have a firm understanding? Trade secrets, on the other hand, I think things are going to change because of, I won't bore you with the details, but there was a new law that was implemented last year called Defend Trade Secrets Act, DTSA, that's going to cause, hopefully, a lot of clarity around this situation, because now it's a federal law instead of a state UCC supported law. The problem with trade secrets is it's both from you would consider physical security, information security, but it's also from a legal side. It's what am I doing to protect my interest from a general contractual indemnification side. And that's where the issues are right now, of really trying to hone in on what constitutes intangible asset valuations. It's the valuations piece that people don't necessarily understand. And so when we are talking about intangible asset valuations, and specifically trade secret losses, how do we value those? If you're thinking about from a property side, that whole pairs and sets, just because it's exposed doesn't necessarily mean that it can be utilized out there. Should I have the full amount paid out, yes or no? What about my R&D costs? It's not necessarily a product. And so there's so many different nuances of even talking about trade secret coverage that's where the markets really don't have an understanding right now. And they already know that they've been hacked. They already know that there's been some serious issues. They just are not comfortable yet. And I'm okay with that, but it's something that we have to change from an industry side.
Yeah, but from a modeling standpoint, we're not going to model what was the value of the trade secret. It's really the attack that gave rise to the trade secret being lost. So it's some kind of data breach.
Yep.
And so that is imminently modelable, but I can see where valuing the trade secret is going to be a fight for the lawyers. You have X million dollars worth of coverage, what percentage? And that would be something that would be left up to them. We would be focused on how susceptible you are to the data breach that could be triggering your loss.
Great, thank you. We have another question. We have one here and one there. Oh, we have two there, one over here. We've got time for a couple more quick ones, so go ahead, sir.
The question to Laura, isn't this a question of innovation and exclusion? Thinking that there's innovation by the people who threaten to do what has always been done, theft, destruction, and then the innovation is they happen to use a keyboard or a network to do that. And then there's an exclusion when that happens because it was cyber related. And then the result of that ultimately is new cover in terms of cyber, so covering the same old event that happens to be caused by a cyber actor.
Yes, I agree. It's innovation and exclusion. I think that's how almost every insurance product develops. I think the problem is, though, the innovation occurs, and if you want to successfully exclude it, if that's your desire in coverage, then you need to understand that innovation. And sometimes there's a lag between, this happened, this system was breached, but it doesn't necessarily mean we automatically understand how that occurred. And it's also extremely difficult to craft exclusionary wording that is specific enough that says, I will cover breaches arising out of all of this area, but not this one small part. Because a lot of times there's so many unknown details: who actually started the breach, why they started it, what the net result was, whether the data was ever used. And so you can't really say, this happened, I want to exclude it, and I'm going to be able to come up with a crystal clear exclusion that's going to exclude just that one thing. So when you look at cyber policies, most of the exclusions that you see are pretty standard industry exclusions of what we're not going to respond to. Every cyber policy still has an EPL exclusion on it. And so other than some government intrusion exclusions that are on policies, most of them are fairly standard because we haven't found a successful way to say we want to carve out this specific exposure that results from a breach and exclude it entirely. So we tend to just say we're on all of them.
Another question over here.
Yeah. So there was an excellent conversation about how coverage seems to, that the take-up rates among large insurers are quite a bit kind of coming down to SMEs. When do we see the cyber coverages being extended out to personal lines?
It's happening now. It is happening. I work for Nationwide. That's what we're working on. Hartford Steam Boiler has a program that they're already attaching to, they make it available to multiple insurance companies to attach to personal lines. It's something I've been somewhat involved in. It's somewhat confusing, and people don't think it's a big deal, but as wired as our houses have become, it's a very big deal. When your security system is operated through your PC, when everything in your house operates that way, it's an increasingly bigger exposure. And the problem you see on personal lines, unless you're talking about high-end homeowners coverage, they aren't going to want to pay for that coverage. But it is out there, and it's starting to become more common. And as I said, carriers like HSB have started to have an add-on that you can buy if you're any personal lines insurer and include that on your risk. So it is coming, but it's more complicated than I think we thought it would be, just because technology is advancing so fast, even in that area.
Great, thank you, Laura. We've got one more question. We've got enough time for one more question. Go ahead, sir.
In the UK, the government makes no secret it's been disappointed that the insurance market hasn't yet driven businesses to implement better cyber security. And one argument is that companies, when buying insurance, aren't able to halve the cost of buying the insurance by saying they've got a certain standard, ISO or something else, to demonstrate that the insurance should be cheaper. Can you tell me, please, are there big percentage differences being achieved by American companies by demonstrating good cyber governance?
Huge, huge. There's a big difference between, thankfully I work for an international brokerage firm and work with clients also in the EU as well as elsewhere. And there's a huge difference because the market heretofore in the UK specifically, emanated in Lloyd's, has always been that first party non-physical BI. Because the lack of regulations when it comes to the EU side, specifically in Europe, why people necessarily haven't bought cyber policies is because there hasn't been that need to. Now with GDPR being implemented in May of next year, absolutely everybody in the UK, everybody in the EU, well, UK concerning Brexit-wise is going to be interesting, but outside of the UK, from a GDPR perspective, yes, that is the #1 cause concern. The markets in London are trying to now, historically it's always been just the United States, but now they're seeing the entire world in terms of an influx. And so you're going to start seeing more and more. Do they have the same NIST guidelines and same following? No. We're still basically where we are 7 or 8 years ago of this is Cyber 101. These are the policies and procedures that you have to have. By the way, you have to have an incident response plan. Is it tested? Is it not tested? Who's part of that? People are, oh, we don't necessarily understand that. That's not necessarily from a privacy side that we've had to deal with before, but I think things are getting a lot better, and the government is changing it. And the government is the first to establish those programs, and I think that that's where you're going to see it. So it is changing. And this time, 2 years from now, completely different landscape.
Yeah, and I can say from a modeling standpoint, that's what we're all about. You get 2 submissions on your desk. What's the risk of this one? What's the risk of this one? I can't speak to what the price difference is, but you can certainly understand the difference in the underlying risk. That's why you use a model.
There's 3 seconds. 2, 1. Now it's
Well, thank you. First of all, thank you everybody for being here this morning. Great questions from the audience. Would you please just join me in a round of applause for Peter, Laura, and Carl. Thank you. Thank you. And our Master of Ceremonies will direct us onward.
We're going to take a 15-minute break. We'll start the next panel promptly around 10:45. Thank you all. Thank you, Commissioner.